Goldman Sachs says tax reform will have little impact on economic growth. State Street's Lori Heinel thinks equities can continue to rise, and Fidelity Total Bond Fund manager Ford ONeill on what to expect from the Fed. All today on The Bottom Line from the NASDAQ market site in Times Square. Tax reform legislation has passed in both the House and in the Senate and is likely to become a law by year-end. According to a Goldman Sachs report that recently came out, prediction markets are showing an 80% chance of legislation being passed into law by year-end, which is up greatly from October's number of only a 20%. And we're seeing a 95% implied probability of having a tax reform law by the end of the first quarter. But according to the Goldman Sachs report, the benefit for corporations will be quite small, and the effective corporate tax rate will only be dropped by a few percentage points. We also saw a last-minute addition to the Senate bill, which would keep the current 20% alternative minimum tax, which means less of a benefit from the tax reform for tech stocks than we had previously thought. Goldman Sachs economists expect the legislation to boost growth 0.3 percentage points in 2018 and 2019, and note the effect in 2020 and beyond looks minimal and could actually be slightly negative. The 0.3 percentage point boost in growth estimated from Goldman is higher than many of the other estimates that we've seen, but it is much lower than what Republicans are expecting, and that's the bottom line. I'm here at the NASDAQ market site with Lori Heinel from State Street Global Advisors, the Deputy Global Chief Investment Officer. Thank you so much for joining me.
My pleasure.
So looking at equities in 2018, what is your outlook? Do you think that the rally can continue and that earnings growth can maintain?
Yeah, we actually think 2018 could be another good year for equities. We're seeing a synchronized, increasing global recovery, and we're hitting levels of global growth globally that we haven't seen since 1988. So we think that that's a backdrop that can enable companies to continue to get higher earnings and thereby drive the markets higher. And
where valuations are right now, are there any areas where you're worried about valuations? How can valuations stay so high?
Yeah, so the one place where valuations are quite stretched is actually in the US. Other markets, including Europe and Japan and even the emerging world, are pretty much about in the averages that they've been over the last 15 years. So we are watching US especially, but we think that the combination of tax reform, which we're likely to get here imminently, as well as, again, that improving global recovery story will continue to buoy US stocks as well.
And what about tech? Tech seems extra stretched. Do you see opportunities there?
Yeah, tech has been one of the great beneficiaries of the quote-unquote momentum trade this year. So we've seen momentum globally up about 32% versus other factors at around 20%. So we do think that tech will continue here, but we are being a lot more selective. So we're looking at places like semiconductors, for example, and we're really staying away from those FANG names, which we think could go higher, but as you say, they're a bit stretched, and just the valuations don't really warrant it from a risk-return standpoint.
And when you look into 2018, is there anything that you're worried about that could derail the equity market? Are you worried about quantitative easing, unwinding?
Yeah, well, look, there are lots of things that could derail it. One of the things that we're not so worried about is Fed policy and quantitative easing. One of the things that central bankers globally have been very consistent on is that while they're moving into a tightening phase, they're not really pulling that punch bowl away in a rapid fashion. So the Fed, for example, is likely to raise rates here this month, another 25 basis points, and maybe a couple more bites next year. But even if they do that, we're still at about 2.25 on a Fed funds rate. So it's hardly the kind of nosebleed territory for rates that would derail the economy. The area that we are watching very closely, though, is inflation. No signs of inflation in the moment, maybe some green shoots here and there, but something like a rapid escalation in inflation could be something that would derail us.
And would that be because of how the Fed would have to react to that?
Yeah, it would be both how the Fed would have to react, also the fact that companies, part of their profitability story is that their inputs have been pretty contained. So you think about labor price inflation, you think about commodities inflation, other things that become inputs into company earnings that would actually compromise those top top line or those bottom line earnings growth would be a problem.
And what could cause inflation to come, or why haven't we seen the inflation yet with unemployment where it is?
Yeah, well, look, there are lots of discussions around why we haven't seen inflation already, or at least not wage pressures already. And one of the things that we would argue is that we continue to have this global labor market, so you're unlikely to see a lot of pricing pressure from wages, for example, as long as we have more labor market mobility and whatnot globally. Now, if you have trade issues, that could quickly escalate inflation. If you start to have growth even outstrip where the current projections are, that could create some short-term capacity constraints, which could be inflationary. And then you have some idiosyncratic things. For example, in Great Britain, there was some inflation because the pound devalued so dramatically post-Brexit. So you could have these sort of pockets of things. But ultimately, as long as inflation expectations don't get out of hand, we don't think inflation is going to be a problem.
And where else outside of equities are you looking in 2018?
Yeah. So overall, we still think that investors need to maintain positions in bonds. We're really staying away from high quality and sovereigns, and we're looking at things like high yield and emerging debt, that is, because those are places where you're getting at least some quote unquote carry trade where you have 3.5%, 4% returns over and above what you can get in treasuries. And so the risk return there, we think against a pretty good global backdrop is pretty good. The other place where we've got a little bit of an allocation is in long treasuries, but that's more of a hedge against our kind of pro-cyclical positioning across the portfolio versus any real value in bonds.
One of the charts that I like from that's coming out for State Street is where has all the volatility been? Why has everything been quiet? Yeah. It's been 35 years since we've had so few days that had sub 1% returns. What can you tell me about that? Is that coming back?
Yeah. This has been a great conundrum because we have this situation where we have low volatility really across asset classes in equities and in bonds. I think there are a couple of things that are driving that. One has been this, again, central bankers have been very transparent, very consistent, highly accommodative. And so against that kind of backdrop where you don't have to worry about rapid rises in rates, then you can continue to hold equities and live with those stretched valuations as earnings continue to meet those valuation levels. So that's, I think, one of the reasons why we haven't seen a lot of volatility. The markets are telling us, however, that there are concerns at the margins, right? So if you look at something like the SKU index in equities, it's signaling that there is a lot more tail risk out there. So people are worried about geopolitical events, they're worried about cyber attacks, they're worried about all manner of other things. So you could see some sort of a macro or geopolitical thing happen that would derail the markets for a short term, but we think that would be a passing phenomenon and a buying opportunity.
And last question, what is your outlook for China?
So we're actually pretty constructive on China. Obviously, given the recent party Congress, we're going to have stability politically there. And we think they've got the tools at their disposal to deal with some of the challenges they've got around debt levels and things of that nature. And what you have to remember is that today, the incremental global growth is largely coming from China and the Asia-Pacific region. So 2/3 of incremental global growth are coming out of that region, about half of that is China. So China at 1.1 trillion, even growing at 5%, is still $500 billion of incremental growth. So we actually like the China story quite a lot.
And how does that translate into investment opportunities?
Well, really on two things. One is that you have additional support for equities and the things we've been talking about in terms of broader global equities being able to generate earnings, because you have this huge consumer class in China, about 100 million middle-class consumers, for example, that are going to want goods and services and whatnot. And it also is a good opportunity for people to think about China specifically and getting access to companies within China that both will tap that consumer group within China as well as be global players.
Great, thank you so much.
Thank you.
Recently, I spoke to the Fidelity Total Bond Fund portfolio manager, Ford ONeill. Here's what he had to say about the outlook from the Fed and the market on interest rate hikes.
They're actually connected for 2017. Both are assuming one more hike in December. And if you look at Fed funds futures, it's about a 90% chance. So I think the markets and the Fed are in agreement for this year. However, next year, the Fed's expecting another 3 hikes. And of course, they're assuming QE unwind as well. So a lot going on with the Fed. The market, on the other hand, is only expecting 1 or 2 hikes. So again, much more benign in terms of rate hikes. My view is that there's a synchronous global recovery going on, and along with that, some inflationary pressures building. So I think I'm leaning a little closer to the Fed than the market today.
And what happens if the Fed does all three and the market is still expecting 1 to 2?
Clearly, there'll be more pressure on rates. I think more pressure on front-end rates, so 1 to 5 year treasuries. But clearly, there'll be pressure across the curve as well. So it'll be not great for the fixed income markets, but I think we also would love to have overall short-term rates normalized. And I think that's just a question of getting there probably a little bit sooner than the market expected.
You're expecting all three of the Fed rate hikes. Is that because you expect inflation to see more inflation?
My expectation is for higher inflation in 2018. I'm still a strong believer in the Phillips curve. And that means that as unemployment continues to fall, there should be more pressure on wages. Wages remain very, very low. A lot of that, folks would argue it's because of all the global disruptive technologies out there today, but I think there'll be more wage pressures next year, and I think that will help inflation go a little bit higher.
So you expect to see the wage inflation that we've all been waiting for that hasn't come?
I think as we get sub 4% on unemployment, that's quite probable in my mind. At the same time, if you remember, we had a material drop in telecommunications prices and also medical prices at the beginning of last year, and those roll out of CPI. So those will also add to pressure on inflation.
So, and you mentioned the QE unwinding. Mm-hmm. Where do you expect to see the impact from that? Because this is an unprecedented thing that we haven't seen in the markets. Where do you expect to see that?
So I think there's still far more questions than answers about QE. Clearly, it's going to accelerate as we go into 2018. That means more Treasury and more MBS sales. So the question is, will that materially impact interest rates or spreads on mortgages? I think there'll be pressure on both, but there may also be a secondary impact, which is that as banks' reserves that are currently on the Fed's balance sheet are unwound as well, that may pressure them to reduce some of their credit exposure as well. So there may be also, as I said, a secondary impact on credit spreads going a little bit wider.
And when you look at the bond and equity markets right now, what information are you getting from them? What do they agree on and what do they disagree on?
So I think there's a little bit of a disconnect. If you think about the S&P 500 up 15% this year, based on much better economic prospects and higher earnings, you would assume that that would put pressure on interest rates, but rather longer-term interest rates are actually down this year. And what I would argue is that as you think about the Trump agenda, the equity market, I think, is embracing the former positive Trump agenda, which is less regulation, tax cuts, and infrastructure spending. Whereas I think the bond market's a little more mixed. I think they're also concerned about immigration policies and trade policies, and maybe the equity market's feeling a little more sanguine about those too.
Is the bond market more global in that sense?
Clearly. As rates are very, very low in Europe and also in Asia, that's obviously attracting a lot of overseas demand for our market. As you think about developed markets around the globe, U.S. rates are among the highest. We also have a very liquid currency as well, so we've had a lot of interest in our rates from overseas buyers.
And corporate credit spreads are very tight. Bond volatility is really low. What do you expect? What could cause either of those to widen or increase?
So normally credit spreads widen on recessions. However, if you think about the past 8 years, we haven't had a recession, but we've had a number of periods with credits widening, whether it was the European banking crisis in 2011, the taper tantrum in 13, or the most recent commodity debacle in 15 and 16, all led to much wider credit spreads. I think they're priced to perfection today, so even without a recession, in my opinion, I think they could be wider a year from now.
What is the one thing you think people get wrong about fixed income markets right now?
The one thing they've gotten wrong for 8 years in a row is the expectation that rates are going to be a lot higher a year from now. I think after 8 years, we've proven that there are a lot of let's say demographic headwinds to higher rates. Folks are getting older. Structurally, they want more fixed income in their portfolios. So I think people need to stop considering that sort of draconian 200 to 300 basis point increase in rates and assume rates are going to remain fairly low for a very long period of time.